Today we want to finish up the concept of optimal capital structure, do a real quick, very high level discussion of business combinations, and then get started on risk management. We'll spend a couple of classes on risk management. So back to the class notes, page 53. We just talked about, when we talk about capital structure, optimal capital structure, that it's the decision about how much do we have funded by debt and how much by equity. And we said there's this very famous two Nobel Prize winners in economics, Miller and Modigliani, and they said if they're in a world of no taxes, no bankruptcies, it doesn't matter. The value of the firm is the same whether you use debt or equity. But then they said, well, in a world with income taxes, because interest expense is tax deductible, but paying dividends to stockholders is not tax deductible, there is a different answer, because we have what we call the tax shield of debt. So debt, because interest expense is tax deductible, the taxpayer essentially covers part of your cost of capital. So there's an incentive to use debt because you get the tax shield of debt. And we talked about the value of the firm will go up by the amount that you have in debt times your tax rate. And then they said there's also another part to this, and that's bankruptcy costs. If a firm takes on too much debt, it becomes too risky, and its chances of going insolvent because you have to pay those interest expenses every year. With equity, you can pay dividends like you saw in Project 1. You pay dividends when you're having good years, but you can cut back in bad years, and you're not default. You don't have to pay your stockholders a dividend, but you do have to pay your bondholders. So the more debt you have, the less flexibility you have, and the more likely you are to go into default. And there's a cost to debt. So there's a value to debt because of the tax code, but there's a cost to debt if you use too much of it because it's a fixed cost that you have to pay no matter how well you're doing. And so your chances of insolvency are much higher. And we said those costs are direct costs, the actual cost of filing bankruptcy, and then there's indirect costs. Primarily, at some point you take on so much debt that you lose your credit ratings and your cost of debt soars. So in theory, the maximum value of the firm, levered, including debt, is the value of the firm without any debt plus the present value of the tax shield minus the present value of those financial distress costs, those bankruptcy costs. So essentially what you're going to do is you start adding debt to get that tax shield, and you keep adding debt, your cost of capital keeps coming down because of the tax shield. No other reason than the tax shield. But at some point you go beyond the optimal point, and the tax shield of the debt is offset by those financial distress costs. So there is an optimal level of financial leverage. There is a point where you can maximize the value of the firm based on how much debt versus equity they have. It's a trade-off value of capital structure. It is very theoretical, so it's very hard. I can't actually show you formulas and say, hey, plug these numbers in, you'll find the optimal level. Now, if you really want to get into this, especially if you're a finance major, Dr. Damodaran at New York Stern School of Business, his class that I've watched online, he actually goes in detail. In one of his classes, he goes into two companies, Disney and another company, I cannot remember the other company, where he actually does the math to find their optimal level of debt. Now, he uses times interest earned that we use in paper 1. He uses times interest earned to decide where that optimal level of debt is. I'm not so sure that's the best ratio. He uses it, says it's a good ratio. I would have used debt to EBITDA or something, I think that's more closely related to debt ratings. But he does go through the math, and what he demonstrated, I really wish I could remember the second company, but he said Disney was not using enough debt. If Disney borrowed more money, their value would go up because they were on the left side of their optimal capital structure. And he said this other company was taking on too much debt, and they were beyond the point of optimal. Now, I can't remember the name of the firm he did. I did teach a class once several years ago. It was a very small class, where the purpose of the class was to pick a company and go through a detailed analysis of that firm as a class, and all together we've at the very end come down to a conclusion. We picked El Paso Gas, and our conclusion on El Paso Gas is they were well beyond their optimal level of debt. Debt was a huge problem for them. They were harming the value of the firm because they had too much debt. And our recommendation as a class, and this was, everybody knows, about 5 or 6 of us, as we just discussed it, I sent out different analysis for each member of the class to do, and the class came to the conclusion that El Paso Gas needed to get their debt level down, even if that meant selling some assets. And the assets they said to sell, it was to sell some of their pipeline assets. That was the conclusion from that class. Very much Miller Modigliani, saying this firm has too much debt, it's harming the value of the firm. And we finished the class, and just a few months later, the news hit that El Paso Gas was selling some of its pipeline assets in order to pay down its debt. And the class members were just ecstatic. Wow, we figured it out, Professor Reed. This is really excited. They were really excited that these theories actually lead to decisions in corporations. So there is an optimal level. I doubt if you go work for a firm, I doubt you're going to see this kind of Miller Modigliani going on in detail. They probably know it and they probably think about it, but it's not probably a precise number. A lot of firms are very under allocated to debt based on this theory, mainly because maybe they're a smaller firm, or they're a firm that they want to be free to look for new opportunities. And if they load up their debt too much, they essentially have used up that capital. And so there's a lot of firms, their belief is, yeah, we could increase the value of our firm by using more debt versus equity. But if we do that, the restrictions of that's going to close doors if a new opportunity comes up. We'd rather be undervalued but have that opportunity. It's somewhat like the optionality value. It gives us the option to do something, and that option has some value, and how do you account for that? So it's very few firms actually use Miller Modigliani to decide exactly where they're going on debt, but there are firms that are definitely too far on the debt side, like we saw with El Paso Gas, and there's some firms that say we will not have any debt at all. So Lululemon, interesting firm. We saw Lululemon on Project One. They were being compared to Nike, but Lululemon had zero debt. Why is that? What's their philosophy there? This theory says Lululemon can increase the value of the firm if they would buy back some of their stock by borrowing money to do it. Now, what I'll do on the exam is I'll give you a graph, one of these graphs, and you just need to label it and explain it. So I won't have the labels on there. I'll just have the lines, and you have to explain them. But they all have a very similar y-axis. The y-axis is how much debt do they have. So as you go from left to right, over here they're 100% equity, and as you move right, they're going more and more debt, less and less equity, until they're 100% debt. Same thing here, the debt ratio. As you move from left to right, they have more debt. Same thing here, as you move left to right, they have more debt. Same thing here. This isn't debt to equity, it's debt to debt plus equity, but it's the same kind of thing. As you use more debt, you move to the right. So they all have the same structure. You'll notice the first two have on the y-axis, so on the x-axis is how much debt they have. The y-axis is either, there's one of two things. It can be the value of the firm. If it's the value of the firm, then the line goes up and then it comes down. These first two, V means value. These first two, the y-axis is the value of the firm. The next two, the y-axis, is the cost of capital. And here you'll notice the line comes down and then goes up. So that's how you can tell which one I'm giving you. So that's the first thing to figure out. They're all going to go debt to equity or level of debt left to right. So the only question is the starting question is what's on the y-axis. So if the line goes up and then down, we're talking about value. If the line comes down and then goes up, we're talking about the cost of capital. So what's the next thing we have? Well, if it's the value of the firm, essentially what they're saying is, where is the level of debt that we maximize the value of the firm? Now you have three lines. When you have three lines, On the value one, the lowest line is the value of the firm with no debt at all, unlevered. And it's the same line over here because the intercept is a firm that has no debt. The top line here is the value of the firm if there was no bankruptcy costs. So essentially what they're saying, just keep using more debt, get the tax shield, get the tax shield. The red line is the value of the tax shield, then that getting offset by the destruction of the financial leverage. So the red line is the value of the firm. You can see there's some optimal level of the value of the firm. That optimal level is going to happen where the cost of capital is at its minimum level. The next one, very, very similar. So you notice the optimal capital structure, that's where that little dotted line is. The optimal capital structure is where the value of the firm is at its highest. This one's kind of hard to tell that's really the highest. So this is the firm value. This dotted, they have a dotted line instead of a green line, but this dotted line is the value of the firm if there was no debt. And then as they add debt, the value goes up with the tax shield. And again, they have a line here that's just the value with the tax shield, ignoring bankruptcy costs. But then when you bring bankruptcy costs, it brings the line back down. And so you're looking for that optimal line where you're getting as much of the value of the tax shield as you can without that being offset by the bankruptcy costs. On these next two charts, because we're using cost of capital, then the value of the firm is maximized where the cost of capital is the lowest. So here's your cost of debt, the purple line, cost of equity. So when you have cost of capital on the y-axis, your cost of debt's the lowest, cost of equity is the highest, and then your cost of capital is in between. So that in-between line where it's at its minimum, that's where the value of the firm is maximized. So what's happening here? The same thing. The cost of capital comes down only because of the tax shield of debt. Remember, as you add more debt, debt is cheaper than equity, but as you add more debt, your beta goes up on equity, so your cost of equity goes up. And as a result, without taxes, this would just be a straight line. But with taxes, your cost of capital comes down because of the tax shield. But at some point, you use too much debt, and the bankruptcy cost makes your cost of capital go back up. So the value of the firm is maximized at the minimum cost of capital. Exact same chart here. Cost of debt's the lowest line, cost of equity is the highest line, and then cost of capital is the line in between. And see how they say the word theoretical, because it's not a number we can precisely get. Some of it relies on how the bond market interprets the numbers. We don't know exactly how the bond market's going to increase the cost of debt. But the optimal level of the firm is where the cost of capital is minimized. All right. So I've given you some ways, and you'll just have to read through these and figure out your answer, because you have to put it into your own words. You can't just copy and paste this. So you need to listen to this lecture, and while you're watching this, what I'd recommend on these type of essays to avoid the plagiarism issue is listen to it, turn it off, and type it in your own words. And then listen to it again and type it, so maybe do in sections. So you're typing in your own words without saying exactly word for word what I have typed in the notes. So what's a good answer on this whole idea of optimal capital structure? Well, first off, Miller and Modigliani said, well, it really shouldn't matter because the value of the firm is the value of its assets. It's the present value of the cash flows you can get from those assets. So it shouldn't matter. It shouldn't matter if you use debt or equity. So the value of firms shouldn't change if you use more debt, more equity, but that assumes there's no taxes, that assumes there's no bankruptcy costs. So that's the Miller-Modigliani theorem. Capital structure does not matter to the value of the firm in a world without taxes or bankruptcy. But as the firm uses more debt, or the reason for that is the firm uses more debt, and this is important to the answer, as the firm uses more debt, even though debt is cheaper, that increased debt increases the beta, so cost of equity goes up, and because of that, the benefit of using cheaper debt is offset by the higher cost of equity. However, after tax, the value of the firm does increase as you add more debt because of the tax shield of debt. Interest expense is tax deductible. dividends paid to stockholders, and stock repurchases are not tax deductible. So the value of the firm increases as you add debt up to a point where the bankruptcy costs start taking over. So there is some optimal level. The optimal level is where you're balancing the tax shield and the bankruptcy costs such that the WACC is minimized, and that's real important to your answer. We're trying to find the optimal value of the firm where cost of capital is minimized. And why is that? Well, your cost of capital is your discount rate for the firm. But if the value of the assets is the same, you're getting the same cash flow from the assets whether you're using debt or equity. And obviously you have the same assets, but you're going to use a lower discount rate. Obviously that's going to increase the value of the firm. So another way you can do this is, reference the cost of capital without taxes. Reference the KE, which is the risk-free rate plus beta times the market risk premium. Note that beta rises as you increase the weight of debt. The cost of debt must be less than the cost of equity. So why does increasing WD reduce WACC? Well, if you ignore taxes and bankruptcy, it doesn't. Because as you add more debt, cost of equity goes up, so it doesn't reduce WACC. So as WD rises, beta rises exactly the same amount you need, such that the WACC does not increase, does not decrease as you add more debt. That's before taxes and bankruptcy. The optimal value of the firm is where WACC is minimized. So before taxes and bankruptcies, there's no value. More debt, you get the same WACC because your cost of equity goes up and offsets. So even though cost of debt is less than cost of equity, increasing the WD also increases the KE, and so the value of the firm does not go up. But after taxes and bankruptcy, increasing WD, the WACC declines because of the tax shield. At some point, bankruptcy costs take off and offset that. So there is theoretically, I almost think you should put the word theoretically into your answer. There is some theoretical minimum level of WACC, which is the maximum value of the firm. So I did it more in words here, more in formulas here. You might find a way to mix these two answers and get them all into your answer. It's an important concept, but we don't need a lot of math. So I've actually cut back on the math on this versus what you would have gotten in the other class, because they throw things in like preferred stocks and issuance costs and all those kind of things that just are not important to the understanding of this concept. A lot of extra calculations that are just not adding any knowledge. So now there's a few other points to talk about with capital structure, and probably the most important is this term signal. There's a theory behind capital structure that we just saw, but then there's reality, and the reality is a little different than what you would expect from the pure economics of this. So management's number one preference. So you ask, what should management do? Well, Miller Modigliani says, well, they should use debt. That's the most important thing. But that's not how management does. Management starts with equity in the form of retained earnings. Why do they like to use retained earnings? Why don't they pay out all their earnings and just borrow money to keep the firm going? They like retained earnings because there's no signal at all to the markets. It doesn't tell the markets anything. If you're just using your own money that you created, you're fine. If you use debt, debt gives a signal to the market. Management has inside information, and the market says, hey, they're borrowing money. They're not issuing stock. So that tells us something, and what that means. And the biggest thing is issuing stock. The market interprets a firm that's willing to issue stock that they believe their stock price is well valued or even overvalued, and that's the reason they're issuing stock. And you never want management to go out and issue stock in order to signal to the market that they don't think their stock's underpriced. They think it's well priced or even overpriced. Management never wants to do that. That's why management loves buying stock back. If you buy your stock back, you're essentially saying, hey, we think our stock might be a little cheap, so we're going to buy it back. So that's that signal. Management's issuing stock. They must think their stock price is really good, really strong, really high. That's a signal that maybe this stock is expensive. issuing debt also avoids the dilution of your other owners, because if you issue debt, someone who's a 5% owner of the firm, if you issue equity, if you issue more equity, someone who's a 5% owner of the company might become a 4% owner of the company. So their ownership's diluted unless they buy 5% of the new issuance. Since management has inside information, every time management does something, whether it's using retained earnings, using debt, or issuing stock, or buying back stock, those are all considered inside information types of activities. And so the stock market's going to say, hey, management's doing A instead of B. That must mean the stock price is too high. So it's whether the market's right or wrong, and management can obviously try to influence that message as best as they can, but the market looks at that and it interprets it as an insider giving it some kind of signal to the market. Now, management does not like debt from one standpoint, in that it creates constraints on operations. Firm that borrows debt, that debt will have covenants. And those covenants will have restrictions on what management can do. They may be really low restrictions, or could be really high restrictions. I was just reading an article in The Economist. China has been loaning a lot of money to emerging countries, and the discussion was, what kind of constraints does China put onto those countries? Do they actually get collateral? Do they require these countries to do something? The Economist had another article on the IMF, which is this World Monetary Fund that makes loans to struggling countries. What restrictions do they put? So usually when people loan money, especially the weaker companies, they're going to put restrictions and say, hey, unless your net income is this high, you can't pay dividends. You can't borrow more money. You can't buy another firm, whatever it is, the restrictions. So there's a natural tension between bondholders and stockholders. Bondholders, they have a lot of downside risk, but very limited upside risk. Their upside is they'll get their coupon payments. We'll study that here in a little bit when we price bonds. So they have a lot of downside, but very limited upside. Stockholders have unlimited upside. The most they can lose is 100%, but they can make 80,000%. They can have a huge upside. So the bondholders, they're worried about risk, because if the firm struggles and goes under, the bondholders lose a lot of money. The stockholders, we just talked about this, earlier, talking about beta. We looked at beta. That beta says, hey, if I own your stock and it's in a well-diversified portfolio, a lot of that risk gets diversified against my portfolio, and the most I can lose is at 100%. So we want management to take risk, because then I might make that 40,000%. If I lose 100%, then one of my other stocks will make the 40,000%. So stockholders are much more aggressive. They want management to take risk, because they get all the upside and they have limited downside. So there is this tension between the lenders and the owners, and bondholders especially hate event risk. That's when a firm loads up on debt in order to acquire another firm, or maybe it's a management buyout. Bondholders don't like that, and so they try to restrict management so they can't do those kind of things. So as we said, management prefers retained earnings over the debt or the equity, because it doesn't create these signaling effects. It doesn't seem logical from an economic standpoint, but from the incentives of management standpoint, it does make some sense. Dividend policy should theoretically be, if we have projects with positive net present value, we shouldn't pay dividends. We should reinvest in the firm. If we don't have projects with positive net present value, then we should pay it back in dividends to the stockholders. That should be the theory. So firms that pay dividends are essentially saying, hey, we couldn't find anything to do with this money that would add value to the firm, so we're just giving it back to you. All right, so there's Miller Modigliani. Hopefully that makes some sense, and these graphs are making some sense to you. So think about if I gave you a graph like this, but without all the titles, nothing over on the titles, nothing on the x-axis, nothing on the y-axis, no titles, you just had the lines. Could you label the chart and explain it in words? It's about the only essay question on the exam where you have to explain things in words. Almost everything else is a math problem. All right, real quickly, I want to change gears now and go into business combinations. I don't want to spend a whole lot of time on this because it's somewhat beyond the scope of this class. And we don't really have a business combinations course at UTSA. It's talked about a lot in some of the corporate finance classes. The executive MBA program actually has a class on business combinations, which I thought was a little unusual. I'm not sure why they added that class. They said they added class based on what other programs were doing. It just seems like a very specialized finance topic. So, but it could definitely impact your career if you're in a firm that's going through a business combination. It might be great. It might give you new responsibilities and a promotion, and it could be terrible. It could mean that you're going to lose your job. So you're trying to value a business because you want to sell it off. Maybe you have a unit, a subsidiary that you don't think really fits your company anymore. You want to sell that off. You've seen General Electric selling off parts of its business over time, and you have to value that. Or maybe you see a subsidiary of another company that you want to buy. Whatever you're going to do, it's the same math we've been doing. It's the present value of whatever that particular business throws off. And so the value of that is going to be the free cash flows that entity is throwing off divided by your discount rate minus your growth rate. We're going to be looking at this formula more when we value stocks, but we saw that much earlier when we talked about the perpetual growth annuity. That's the value of the firm. It's cash flow divided by discount rate minus growth rate. And you got to figure out what are the free cash flows. You got to figure out what is the cost of capital. You did that in your finance application when you figured out WACC, and you got to figure out the growth rate of the firm. So how do you figure that out? Well, it all comes down to forecasting. If you do this, this is the value of the firm. If you're an equity holder, to figure out the equity value, you would take the value of the firm and subtract out how much debt they have. So, I mean, this is forecasting. You've got to be a forecaster. You got to really value an entity correctly. You got to forecast. A lot of the forecast really is the growth. How fast is, I can sit down and figure out what cash flows they're producing. The question is how fast will those cash flows grow. So where does growth come from? Well, you got to look at the overall economy. You got to look at inflation. What's the industry doing? How saturated is the market? What's the product life cycle? I've seen several mergers, acquisitions going on in the last several years with newspapers. Well, you think newspaper, wow, that's old product life cycle. That's old business. Who would want to buy those? You saw Basil from Amazon buying, I think, the Washington Post. Who would buy these newspapers? But some of them have done really well. The Wall Street Journal is definitely very profitable. They have a lot of subscribers. So, who would buy these? But they have cash flows and they can be valued. There's other products that are in the early stages of product life cycles. There are some really exciting firms that are right on the forefront of battery technology for batteries for electric vehicles. They haven't quite got a product yet. They don't have any revenue, but if their product works and works as well as they think it will, that could be a massive business. So, a newspaper, pretty easy to forecast because you know exactly what their cash flows are. You have years and years. What you got to forecast is what they're going to be doing online and how much subscriptions they have. Not a very difficult firm to value, so if you're trying to figure out how much you want to pay for the Washington Post, you could certainly sit down and do the math. If you want to buy a firm that's forefront of battery technology, but they don't have a product yet, it's going to take them another 3 or 4 years to develop it, but they have patents and they have really good scientists. How do you value a firm like that? That's really difficult. There's a pretty high probability they won't do anything. They'll go out of business or a competitor will beat them and they won't do anything, but there's a small probability they could work and it could just be massive and really radically change the world, and they make a lot of money. So when you're looking at what does management do? What firms does management buy, or what part of the firm does management sell off? It really comes down to stockholders looking and trying to see, is this firm better off if we combine with another firm? Like GE, maybe GE's better off if they sell off some of the subsidiaries. So we're trying to find how we can best maximize the value of the firm. That's the whole issue with mergers and acquisitions and business combinations. You might find that management is really bad, and so you take over a firm and change management. That could be a hostile takeover. You say, hey, I'm a 5% stockholder of this firm. My goal is to vote out current management, bring in new management, and we're going to fix this firm. You could acquire a firm because it's got a really great distribution system. Or maybe combining the firms give you pricing power. That may not go over well with the regulators because of antitrust, but that might be a reason to acquire a firm. Maybe they have redundancies. That is, you combine these two firms, you can cut 5% of the staff because they have all these accountants and others that you have 50 accountants in one company, 50 in another. You combine the firm, you still only need 50 accountants. You just cut that entire department in half. And that's why a merger and acquisition can actually cause you to lose your job. There could be economies of scale. You bring these two firms together, and man, these two firms together, they can spread their fixed costs over much more revenue, and that can be a huge thing. We've seen that, I think, with some of the things Valero has been doing is acquiring some of this capacity that they have to help spread fixed costs. Maybe the firm has a superior process. If you acquired the firm, you could essentially take advantage of that and apply it in your firm. There's sometimes that combining firms you can actually improve the WACC. I think with General Electric, as they sell off certain subsidiaries, it makes General Electric a less complicated business, and the stock market actually gives them a lower cost of capital. So what you're trying to do is figure out if combining this firm or spinning off this subsidiary or whatever, or buying that subsidiary from that firm, if doing that will increase the overall value of your firm, of the firm. That's what mergers and acquisition departments are doing. So it's easy to merge two companies as a stockholder in a stock portfolio. I mean, you can go out and buy two companies yourself and put them in your portfolio, and now you have them. So the stock market can do it much more easily than management. They can't do the synergies and redundancies, economies of scale. But if you want to own Disney and Alphabet, all you got to do is just buy the two stocks and you've got it. If management wants to merge Disney and Alphabet, which would be a really strange merger, they can certainly do that, but would the value of the firm go up? And would you be better off as a stockholder having those two firms merged versus you just buying them separately? So it's tough. Management's doing something that the stock market can do much more easily. Why does management do it? The number one thing they say is synergies. Putting these two, in cost synergies in particular, putting these two firms together, we can cut staff, we can do things more cheaply. Now, Boston Consulting Group has had this thing they used to call combining companies together so that your company has some stars, they may have some dogs, you need a cash cow, you may have a question mark, something that might work out but might not. They taught this for years. I saw a guy from Boston Consulting Group several years ago and said, are y'all still pushing the stars, dogs, cash cows? He says, no, we gave up on that. And the reason they gave up on it is management should never do an acquisition in order to diversify their firm. That is never a good reason. And that's what Boston Consulting Group was saying, is management should go out and acquire the firms so they got a bunch of different things going on and diversified. That is the thing that the stock market itself can do so much better. If you need to diversify yourself, you can buy Disney and buy Alphabet. You don't want management to merge those two together so that they're diversified. You're already diversified. So stockholders do that themselves. So as management is going to merge two firms together, you want to do it for some type of synergy, some type of advantage that you're going to have. Now, mergers can be conglomerates, or they can be horizontal or vertical mergers. A conglomerate is like General Electric, where you're just mixing together a bunch of different businesses. It is rare that is a good decision. The stock market does not like conglomerates. I think General Electric has been really harmed because it's a conglomerate. GE argued that there was an advantage of them being a conglomerate because they were so good at capital management. They were so good at return on capital, that economic value added we talked about. They were so good at that you were buying GE stock because their management was so good at managing the return for their stockholders. So it didn't matter they had all these diverse businesses because of their philosophy. That really has not gone well for them at all. They're a firm that has struggled dramatically. Now, some firms are conglomerates like a Berkshire Hathaway. I think Berkshire Hathaway, the reason the market gives them somewhat of a premium is essentially Berkshire Hathaway is you're hiring Warren Buffett to manage your assets. So it's almost like Berkshire Hathaway is a mutual fund being run by Warren Buffett. So it's a little bit different model. Some conglomerates have really fallen out of favor. Boston Consulting Group might have made them popular. Management's thinking we got to diversify our business. But financial theory took over and said, no, we really do not need management to do that. The stockholders can do that themselves. So the most popular mergers today are horizontal mergers. Two firms in the same industry merge. A lot of times they're doing that in order to gain pricing power or market power. Regulators do not like that. They may shut that down. But you sometimes will see, you are seeing that a lot in the big tech companies, where you see Facebook or Alphabet or even Amazon. You're seeing it, in the online retail business, of buying a competitor, not because of synergies or economies of scale, but more to buy a competitor just to put that competitor out of business. And that's the kind of thing you're starting to hear Congress talk more and more about, breaking these firms up. Breaking up Amazon, breaking up Alphabet, breaking up all these firms. But horizontal mergers, and then vertical mergers is when a firm buys either a supplier or a customer. I say buyer, I mean customer here. So you buy someone along the line. There you're trying to either get pricing power over one of your vendors that sells you something, or you're trying to take advantage of some natural fit between your two firms. So those mergers, I've seen more horizontal mergers over my career. Something like when Exxon bought Mobil, that's a horizontal merger. The two just combine. Vertical mergers you don't see as frequently, but they can be pretty interesting. We're starting to see some of the telecom firms and cable companies starting to buy companies. Cable companies buying firms that actually do production, that actually build and produce shows that they can put on their cable channels. That's somewhat of a vertical merger. And then the ones that the bondholders hate the most are leveraged buyouts. That's when a group of investors, maybe management, they come in, take a lot of debt, buy a firm, and then they take as much cash out of the firm as they possibly can, and then they leave with this firm that's just overridden with debt, and the bondholders are going to lose a lot of money. So those kind of mergers are going to essentially crash if the economy goes into recession, because they're just so overladen with debt. So that's business combinations. If you want to get more into this, if you have a Bloomberg account, especially if you're a finance major or accounting major too, I recommend you get a Bloomberg account. Bloomberg has a very, very good mergers and acquisitions platform. So if you just go on the Bloomberg, you can just type the words search, and in the search just put mergers and acquisitions, and you'll find, I think it's just MA is the function, and they'll give you all kinds of really good information. Now, the big term today is SPAC. That's a term I was not familiar with, except for now you just see it all over the place. It's, if you're a finance major, I strongly recommend that you make sure you know what a SPAC is. It's a special purpose acquisition company. Um, I just read an article today in The Economist that was talking about, there was actually two articles right next to each other where they were using SPACs as the way to acquire firms. So there were many SPACs here recently. It's kind of a way to avoid the investment bankers quit paying Wall Street so much money. So it's a little bit of a threat to the finance industry. Some people think these things are terrible, but I would do some research. There's some interesting podcasts out there. I've heard some podcasts of some of the leaders in the finance world think these are just terrible things. But there are ways to do all this stuff that we've been doing with Wall Street investment banks, but now people are trying to do it in a little bit less transparent and obvious way to essentially try to do this a little bit more in stealth and save some fees. So that's the new big phrase. There's also direct listing. That's been much more popular recently. I think you've probably heard about Spotify. You might look up Spotify and their direct listing. I know Airbnb has thought about a direct listing. Direct listing and SPACs are not the same thing, but I'm not in the position to give you a detail on the differences because I'm still somewhat learning the legal differences between the two. But this world is changing. So a lot of students say, hey, I want to be an investment banker. I want to do mergers and acquisitions, and that is a really lucrative place in finance, no question. But just be aware there's some competition coming from outside of that industry to try to do these things without having to pay all those fees to the investment bankers. So SPACs and direct listings are two the key. So if you interview with an investment banker, I would make sure you know those two phrases and know some background on what's going on and know a few examples. There's some big examples under either one of those, big examples of firms that did either one. All right, so that takes us to our whole new topic, which is risk management. My favorite topic. I teach a risk management class. I actually believe risk management is the most important thing we do. My risk management class, they just had to do their first paper, which was to go into a major money center bank like a JP Morgan or Goldman Sachs and actually write me a paper on their risk management process. And it's a major part of their annual reports. It's usually 30-40 pages. And it's a very difficult paper to write because there is so much jargon. Some of the jargon they use we're going to talk about here when we talk about risk management. But banks' risk management is extremely important. Insurance companies, really now any firm out there, risk management is going to be a big part of the department of their company. When I started in finance, probably over 30 years ago, my department was right next to USA's risk management department. And USA's risk management department was one guy named Jerry. One person named Jerry. And all he did was just buy insurance for USAA. That's all he did. Today, risk management at USAA, I think, is over 1,000 people. So they've gone from one person to 1,000 people. I think one is way too few. I've told some of my friends at USA, as my word, 1,000, that seems like too many. What are all these people doing? I have some alums. There are two UTSA very strong alums that extremely well at UTSA, and they're now in risk management at USAA, and they know I'm a little bit suspect of the size of their departments, but they love their jobs and they're really getting into it. Risk management in a department like that is somewhat finance, but it's really going into a whole new world. You're really getting outside of finance. So I view risk management, the official function of risk management, that's the part I have questions on. I really do challenge a lot of what firms are doing. But then there's risk management that is just what everybody does. I think every single employee in a company should be a risk manager. And I believe all finance majors are risk management. Even though they may not be officially risk management in their job title, I think all of finance is risk management. It's measuring risk. It's making sure you're getting compensated for risk. And so we want to introduce this today, and then we'll get into it in more detail in the next video, and you'll see your finance application on risk management is probably the easiest one of all. It's a very short application. So if risk management is so critical, you have to ask the question, why do we keep seeing these huge problems? If it's so critical and firms are putting all these resources in it, you go from one person in risk management to over 1,000, then why haven't we fixed all our problems? So there's a great book. I really like this book. It's by Glenn Holton. I pull some of my data from him. You'll see the book a little later. But Glenn Holton, he's a famous risk manager, and it's not a book. It's an article he wrote on risk and why risk seems to keep getting larger and larger. And in his book, he talked about these huge losses that we've seen in the 90s. So Barings Bank, Orange County, ValueJet, these massive losses. And yet you look at those, and even a huge loss like long-term capital management and Enron, you look at some of these losses, and boy, they look so small versus what happened in 2008. So they keep getting larger. And the point of his article back in the 90s was, wow, the risks are getting bigger and bigger. One person, a small group of people are causing these multi-billion-dollar losses. Why is this happening? We never saw this in the 60s and 70s. Why are we seeing such huge losses? And so since he wrote that, we've had Bear Stearns, Lehman Brothers, AIG, Merrill Lynch, Washington Mutual, just huge events. In fact, Merrill Lynch in one day lost more than probably the sum of all these others put together. So just huge losses. Long-term capital management. There's a great book called When Genius Failed, which goes through that one. I highly recommend that for finance majors. Goes through that they so relied on quantitative type of analysis, but very little human judgment, that their models just weren't quite as accurate as that they thought. And then in 1998 they went under. Barings Bank, there's a great book on them, a book called Rogue Trader by Nick Leeson. I recommend all accounting majors that are thinking about auditing to read that book. Orange County, one of the largest defaults by municipality in history up to that point. Since then we've had a couple of bigger ones. But there's a book by Jorian called Big Bets Gone Bad. He actually has an article on it that I actually think is better than the book. But how did these things happen? And then Enron especially, there's a few books on that. Boy, they're massive books. People have written about Enron. But how in the world did this firm do that? Texaco, I think, boy, you have a firm like Texaco where their management is just despicable human beings, from any type of understanding of what kind of people we want running businesses. Just very sexist, very racist. And in their meetings, they were just, it's all these white men in their meetings making fun of women, making fun of minorities. So that's pretty despicable. But then you have the person taking minutes for the meeting actually recording the meeting so that he can go back and take the minutes, and those recordings become public. That's a huge risk. Now some people say, well, if that's the case, the risk management should be don't record your meetings, or make sure to destroy the recordings afterwards. I don't think that's the answer. My answer is don't hire people like that. And I could tell you stories from my career of people that they might have been smart, well trained, great credentials, but they were just horrible people. And those type of people, as your CEO or CFO, they by themselves can bring down an entity. And you've seen some of that here recently, where a major either the CEO or a major player in an organization had to resign because of the harm they were doing to the company. There are some good stories of risk management. So Tylenol had a major public relations issues. Someone tampered with their product. Most people give that as a good example of risk management. They use public relations to get back on their favor and manage that. There are some people who actually are critical of Tylenol, but that's usually shown as a good story. Microsoft has been sued repeatedly by antitrust, especially in Europe, just getting too big, too powerful. Some of that has fallen off because Microsoft's strength was obviously with the desktop and Windows, and now it's so much more moving to online and the cloud, and there's some competitors out there, and Python and other things a lot of people are not using as much, so that's somewhat helped them. But Bill Gates' initial reaction is, hey, if they don't like it, big deal, I'm not going to do anything, I'm not going to pull back on what I'm doing. And so his public statements really did not help Microsoft at all. Now we're seeing the exact same type of discussion going on with Facebook and Amazon, and you're seeing Alphabet, you're seeing Europe and even the U.S. Congress talking about these firms being too big. I just saw Elizabeth Warren. She's been talking a lot about breaking out the banks. I saw her just the other day saying, isn't BlackRock too large, too big to fail? I've never heard anyone talk about BlackRock being too big and needing to be broken up. Tobacco industry got sued for hundreds of millions of dollars because their product was killing people and was addictive, and there was evidence that they knew that. September 11th, this is a big issue on risk management, that if you do your job well in risk management, you get no recognition for it. So if somebody a year or two before 9/11 had said, maybe someone in the FAA or someone had said, we've got to start locking the cabin doors on airlines. And the airlines say, a word that's going to cost us millions of dollars to put all these new doors in. It's going to slow us down. That's just terrible. The pilot union says, wow, you want to lock us in the cabin, and why can't you just trust your employees? But if someone had done that and it prevented 9/11 from happening, no one would have ever given that person credit. No one would ever say, wow, sure glad we closed the cabin doors or 9/11, because we would have never known. So good risk managers are not famous. In fact, in our society, what we do, we have people making bad risk management decisions, and then they're the ones we go to fix the problem because they have all the knowledge and expertise. So we saw that here in San Antonio with the snowstorm and the cold weather and all of that. And my risk management class, we're actually going to discuss that as a case. What should the energy companies, the utilities of Texas, what should have they done differently? And there is evidence that they were told about this years ago, that they needed to spend more money on their cold weather processes, and they decided not to spend the money, that they would just take the risk, that essentially, it doesn't get that cold in Texas, and if it does, we have a couple of days of down, but that's cheaper than doing all this. So there are some critiques that they should have done that. If they'd done that, they wouldn't have gotten any credit for it. In fact, people might complain because their utility rates were higher. So Global Crossing was a firm who wanted to connect the U.S. to Europe with all these cable lines. Really important today. You're actually seeing that that's the right thing to do. The problem was they just went too fast. They got way ahead of themselves. So, and then all of these, boy, there are some great books. There's some books I can definitely recommend on the 2008 crisis that I find very, very fascinating, what mistakes were made in that year. So I don't care what your major is, risk management is huge. Obviously in finance, obviously in accounting, but cybersecurity is pretty obvious. If you're a management major, risk management is huge. Risk management for a management major is you've got employees calling in sick because of a pandemic, or they don't want to come in at all, or you've got a supply chain issue because we saw that big boat stuck in the Suez Canal, and so now you got this backlog, and now people can't build cars because they don't have the parts they need. So the supply chain management for a management major is what happens if this stuff, if your product is not delivered on time, what are you going to do? How are you going to handle that? That's a risk management. There are things that you can do now that you can reduce the frequency of that happening, the probability of it happening, or reduce the severity of it if it does happen. So So here's the article by Glenn Holton. It's called Enterprise Risk Management. He said in the 90s we started seeing, and that's really when it started, in the 90s, started seeing these massive losses. But each one of these, that's why I say you add all of these together and it's smaller than what Merrill Lynch lost in one day. But why did he say this is happening? What's changing? And what he said is different today. Is today, unlike in the 60s and 70s and before, one person can do tremendous amount of damage. And the damage they do could have been prevented with good oversight, but because the world's getting so complex, that oversight is often not there. I always tell the story, USAA allowed me to do a lot of derivatives. I wanted to do derivatives, and they worked really, really well. It saved USAA a few $1 billion in 2008, worked really, really well. However, they gave me the power to do derivatives, but they didn't put any constraints on me. And I had to put my own constraints on myself because they gave me enough power to destroy the entire company. I could have done trades that would have been just disastrous if I'd wanted to. I wouldn't have done that. I had no reason to, but their risk management was, well, it's Ron. He's worked here for years. We trust him. That's never good risk management. And so I had to put processes in place that every time I did a derivatives trade, someone looked at it to make sure it was appropriate, that it was in the scope of what I was supposed to be doing. And then I told the CFO that. I said, hey Joe, you allowed me to do something that was really dangerous. I put these constraints in, so that's not an issue. I just wanted him to know that, USA just willy-nilly said, yeah, let Ron do what he wants to do. If he wants to do billions of dollars of transactions that can bring the whole company down, we trust him, let him do that. And that is a part of risk management, is people just stop and think, how could I destroy this company? And if one individual can destroy the company, you better make sure to have constraints so that they cannot do that. And why can one person do so much damage? With exactly what I was talking about, it's the leverage of these new financial transactions. It's not that people are worse today or more evil today. It's that we've given them much, much, much more power. Also, the other issue that Holton doesn't talk about, but I think we're seeing, is how much more interconnected the world is. So you just saw with the Suez Canal, I don't know how many people were driving that boat, but whoever was piloting that boat, that one person or those few people have caused this massive several-week delay in supply chain around the world. Just a few people. So the world's becoming more interconnected. When you think about it, I was listening to an article about China and Taiwan and how critical Taiwan is to the supply of semiconductors in the world, and yet China's talking about attacking Taiwan, bringing Taiwan back underneath China. What would happen to the world supply of semiconductors if that actually happened? How would the world react to that? There's some, we become really, really quite dependent on very focused area. Another area is car batteries for electronic vehicles. And the Congo produces all this cobalt, like 70% in the world. And it's true, Elon Musk and others are trying to find other ways to do the batteries without having to use these precious earth types of assets. But we have concentration in that's a very unstable country, has had a lot of civil war, and yet you have this whole industry that's heavily dependent on them producing this one item called cobalt. So I think it's the leverage of derivative instruments, but I also think it's the way the whole world has become so concentrated and so dependent on certain places. So risk management will determine who's the winners and who's the losers. And he says for risk management to work, you must have a good culture. A good culture is you have the ability to confront bad behavior. People don't have to take personal risk, the risk of being fired, by pointing out an error that someone else is making. I loved it at USAA. Our CEO at the time when I was there, but before Joe Robles, Bob Davis was there, I could go to Bob Davis and say, wow, I really think this is a risk, we need to do something about it. He might yell at me, and sometimes he would just really beat me up in public, but I discovered he wasn't mad at me, he was mad at the situation. And actually I discovered that the people he was firing were the people who weren't coming to him with that stuff. I even had people call me and say, Ron, you haven't been fired yet, man, he really beats up on you in public. I had to learn not to take it personally. You know, I was giving him information. This is going wrong. It needs to be fixed. We need to address it as soon as possible. And he did not fire me for that. He just said, hey, let's fix it. But he got really upset, and he certainly let it be known. So his technique might not have been the best because it sounded like he was beating up on the messenger, but he definitely wanted to hear it, and he fired people who did not come to him. So he tried to make that clear. If you've got an issue, you bring it to me. If I find out you knew about it and you didn't bring it to me, you're out of here. So you have to be able to rock the boat, ask questions, challenge the establishment. This actually sets up a really good question for your interview. A lot of times interviewers will ask, what questions do you have for us? And a good question would be, hey, I want to work in a company where every employee is a risk manager. We can ask questions, we can challenge things. I mean, you don't want to get them worried that you're going to be some rabble-rouser. But you know, I want a firm that, you know, if I see something I think is important, you know, that I'm not going to be a troublemaker. But if I see something, I want to be able to raise it to my management, and the firm does something about it. That we're all in this together to make this firm better. That would be a great thing to bring up. First of all, because you want to work for a firm that is like that. But secondly, if it is a firm like that, they're going to love that you brought that up in the interview. So a good culture says what's condoned and what's shunned. So it's individuals making decisions. There's a lot of questioning. There's people, including management, that are willing to admit ignorance. And then you have to have good procedures. I won't read through what he says on procedures. You can read that, but procedures can be so massive that they're almost untenable. When I started as head of equities, they brought in 2 thick books of my procedures, and it was like, there's no way I'm reading all of this. So I just told my compliance officer, you let me know what I need to watch for, because she knew it in detail, but I didn't. And then you need good technology, but the technology should support everything else. Too many firms buy the technology and try to get it to do something. You got to figure out what you want to accomplish, and then buy the technology to do that. All right, so we'll start here on the next class and get into that next Excel application. So the next class will definitely, we didn't do any Excel applications in this class, but the next class will definitely do the risk management Excel application and talk about some of my favorite topics.